And good afternoon once again, Market Rebels. Happy Friday, everyone. And last that I checked, last maybe 10 minutes or so going into the close, we have retraced about 50% of yesterday's, the actual body, or what's called the stick of the candle. So we'll have to see if we can get a continued rally, if it can get teeth from what we tried yesterday, but kind of some mixed earnings coming in. So we'll have to see. Next week is going to be a lot of information coming out, and that's going to make it a very interesting week. So for today, what I wanted to talk about is a topic that I think is super important for all of the traders out there, and that is, when does an at-the-money option begin decaying faster than average? It's not kind of the typical question you would ask, but it's something that professional traders look at a lot, is to try to figure out when you are faster or slower than average. It's going to give you a lot of good insight into when you should be rolling or buying or closing or whatever. So these are some of the things that you have to be aware of. Now for today, I'm just going to be talking about an at-the-money option. The rules change as we go to in the money and out of the money, but this is one that I think most traders really overlook, and I think it's a super important topic. So let's start with a little time decay graph. I think everybody is familiar with this. It's pretty hard to take an options class without seeing this time decay graph. And what we're looking at is we have days to expiration along the horizontal down here. So I've got an option with 100 days to expiration. Over here on the far right is 0. On the vertical axis, we have prices. This would be the options price. So in this example, we've started with an option priced at $10 with 100 days to go. And one thing that you'll notice is that at the halfway point, all right, 50 days remaining till expiration, that option is trading for about 7. It's only lost about 30% of its value. Remember, it was trading for 10. And a lot of traders would think, well, when half of the time has passed, half of the option's value has come out, and that is simply not true. This gets back to the square root pricing rule that we've talked about so many times in the Q&As. These are super important topics for understanding your strategies. So again, the first thing to understand is that this shape that we're seeing here in red applies only to at-the-money options. So one question that we might ask is, well, what is the average decay? Now, the average decay is something that we usually don't talk about, but there's no reason that we can't. But what would be the average decay? Well, that would be very simple. We're going to say the option is priced here at 10. There's 100 days till expiration, so $10 divided by 100 is 10 cents per day. Now, again, unfortunately, a lot of times new traders will say, oh, this option is going to decay at 10 cents per day. That is not true. That's the average rate of decay. And we could graph it like this. It would just be a straight line connecting the $10 price with 100 days to go down to the 0 price with 0 days to go. So that would be the average rate of decay. So what this is telling us is that if we had, let's say, 90 days to go and compared it to maybe 89 days, that difference in that blue curve would be 10 cents. We set it up that way. That's what it means to be the average. It's always going to be 10 cents per day. But if we were to look at the red graph and how much did the option actually lose, it would be only 5 cents. So we are decaying at this point much slower than average. We're decaying only 5 cents per day instead of an average of 10 cents. Now notice that if we pick another spot, maybe towards the center, maybe with 55 days and 54 days, what's the average? Well, hopefully you said 10 cents. Again, that's a whole definition of the average. It's the same number all the way through. But if we were to look at the red curve, we would find that it's actually 7 cents. It's a little steeper than it was back here, but it still hasn't caught up to the average. We move out to a different location on the curve, maybe with 25 days compared to, let's say, 24 days. The average would be 10 cents. And at this point, the rate of decay on the red curve is also 10 cents. Kind of interesting. We finally caught up. They are now moving at the same rates. And then finally, if we come out here towards the end, let's say maybe with 10 days and with 9 days, the average again is 10 cents as expected, but the red curve is now 15 cents. We're now decaying faster than average. So that's kind of what we're talking about here is where is this point? When do we begin decaying faster than average? So in order to find that, we have to find where they're equal. Now, one way to visualize that is to simply take the slope of that blue line and we're trying to compare it to the slope of the red. Now, what makes this tricky is the slope of the red is not a straight line like it is in the blue. It changes. But what you can do is you could kind of slide it off to one side like this and find out where they're just touching. And we would say at that point they are equal. Now here's a good way to visualize it. Let's say that we have two snow skiers. I often tell traders to think of this like two side views of a mountain. So here's our first snow skier in red, and we're going to compare him to a snow skier on the blue mountain. And you can tell visually that the blue skier is going to be moving faster, right? He's on a little steeper slope, or in other words, the decay is faster on the average curve than it is on the red curve. Now, that is going to be true all the way up until this point where they just meet. This is the point that we're trying to figure out where they are equal. And it turns out that anything beyond that, obviously now the red curve is decaying faster. So this point right here actually happens to be when 25% of the time remains. Regardless of how much time was on the option to begin with, when 25% remains, or in other words, 75% has passed, those rates will be equal. Now, we could also go back to which I briefly mentioned was the square root pricing rule. Okay, and we could say that the square root of a quarter, 25% of the time that remains, equals a half. And that's the way that the math works out. The Black-Scholes model is telling you that at that point, half of the option's value remains. Okay, so we had a $10 option, and now it's a $5 option. But notice it didn't occur when we had 50 days remaining. It occurred when we had 25 days remaining. And that becomes important for strategies. So let's take a look at some of these key points. Notice that the first 50% of your option's price is lost in 30% of the time. And I'm sorry, I said that. The first 50% of the time that 30% of the option's price is lost. That's what we saw with the option coming from $10 down to about $7. But then the next 25% of the time, we lose 20% of the value. Now that might sound like it's slowing down, but it's 20% over half the range. Okay, so we are accelerating through here. And then finally, the final 25% of the time, we lose 50% of the option's price. Now we can look at this in a different light. I could say that the first 75% of the time that we lose 50%, and in the final 25%, we also lose 50%. So think about that. See, the implications here is that so many times traders will sell a call and at the money because they'll say, oh, it's got the fastest decay. And yet they hold it and try to close it somewhere back in here. And they're taking all of this risk and all of this effort really for nothing. Part of the trick is to try to get down into this range. Now, that's not saying it always has to happen, but it should be part of a goal because you're going to get exactly the same amount of return in 1/3 the time. So let's take a look at an at-the-money option. So remember that when 25% of the time remains, the at-the-money option begins losing value at a rate faster than average. All right, so for long options, be careful of allowing at-the-monies to get within that final 25% zone. For short options, try to hold beyond that 25% zone. And again, this is what a lot of traders fail to do. So let's take a look at a short call example. Let's say we have 28 days to expiration, 30% volatility, 1% interest rates, and Black-Scholes pricing model says that the at-the-money $100 call is worth $3.30. All right, so we got 28 days to go. So here's 28 days. Here's expiration. The call is worth $3.30. And notice that when you get to within 7 days of expiration, that the $100 call is now worth $1.65, or you could say that you have gained $1.65. And this is where a lot of traders are going to start closing it down. They'll say, well, I've made 50% of it. But take a look at the remaining 7 days. Okay, so it took 21 days to get $1.65, and in 7 days, you're going to get $1.65. You're going to exactly match that effort in 1/3 the time. Now, yes, there are some issues or things with gamma. There's a lot of other things to consider, but I think this is the real key that most traders overlook. They don't understand that there's a real asymmetry in the way that option prices decay. So that's important to understand whether you're the long position or the short position. So I hope that gives you some things to think about. And as always, we'd like to extend an offer for a free 30-minute one-on-one consultation with one of our many professional coaches. Many of them have decades of floor trading experience, market makers, and it's just amazing of what they can teach you in such a short time. And because we have so much confidence in that, we're willing to do this for free. So the phone number is 888-809-8058. Please give them a call. It can really be a big step into helping you make better decisions. Now, one last final housekeeping item. On Monday, we have a roundtable at 4 p.m. Eastern, so we will not have trading tune-up, unfortunately, but we will pick back up next Thursday and Friday. And so I want to wish everybody a good weekend. I hope that helped, and we'll look for you then. Thanks so much.